what has all this stimulus and 0% interest rates led to? The capital markets casino. Equity market valuations have exploded. As you recall, last year I had the most prevailing thing that people would ask me is, how can the equity markets be rising when the economy is getting crashed? And it was one simple reason. Look at what the Federal Reserve was doing. The more money they pump into the system, the more it's going to rise asset values. Because again, what does the Fed do when they expand their balance sheet? They buy mortgage-backed securities, they buy treasuries off the balance sheets of banks, insurance companies, investment banks, pension plans. They take that on their balance sheet. What do they send back? They send back cash. What does that cash do? That cash goes looking for a home to generate a return. And so money flooded into the equity markets and into the bond markets. So after last year's big returns, now we have the equity markets up, the Dow up 18%, NASDAQ up 21% this year, and the S&P 500 up 23%. Interesting, I show you the different sectors and how they've performed. If you recall from last year, the worst performing sector last year was energy. Remember when energy prices went negative last year because they didn't even know what they could do with the oil? Financials were the second worst performer. Now, what are the two best performers? Energy and financials. Technology and infotech, which had huge years last year, still had a pretty good year this year. Infotech up 24.47. Real estate was the third best performer. REITs got hit, but not as bad as financials and energy last year. What the Federal Reserve has done now has created the biggest bubble in equity market history. We've never had a bubble like this in our country's history again. What does this graph show? This graph is looking at companies with the total share of market cap of companies that are trading at over 20 times sales. Now, in my personal opinion, no company should ever trade over 20 times sales. Companies should be valued off what they can produce in cash and earnings. But we've only saw this one other time where during the heart of the internet bubble, $3.6 trillion of market cap companies were trading at over 20 times sales. Now we have $4.5 trillion. Folks, I could sit here all day long, and I have some more, show you graphs to show you how distorted our capital markets and equity markets are today. I could have pulled a graph where I was debating another one that was showing the amount of companies that are losing money, have lost money for 3 years, and what percentage of their market cap is. I could keep going on and on. Our capital markets, our equity markets are broken. What's also fueled this? Retail investors poured in. They're sitting at home, they're getting stimulus checks, the equity market starts to rise, they got to get in on the action. So they started flooding in, and you saw unbelievable amounts of leverage. So we've had an explosion of margin debt. I don't think it's ever good to have too much leverage underneath your assets, because we know when things turn, if you're too levered up, what happens? You're going to get liquidated down in a way you don't want. What also has happened is this other graph looks at call and put option contracts in the U.S. Now, options trading is largely for very sophisticated investors, because not only do you have to get the price right, you have to get the timing right. And you can make a lot of money or you can lose a lot of money if you don't get both of those right. But what has happened? The retail trader has become an option trader. And now you have more options trading than the underlying stocks. That is so perverse I can't even begin to tell you. That is the tail wagging the dog. And it is not a good dynamic, because when this unwinds, there is going to be huge capital loss for all those people playing in the options market. Now the meme stocks. We've all heard about the meme stocks. It started with GameStop and AMC. Why do I show you this? Because this is probably one of the best examples how broken our capital markets and equity markets are. These are two companies that are fundamentally busted. What was GameStop? That's where you'd go buy your video games. I'm not a video game guy, I'm too old, but that used to go to a store, go get your video game. Now what do they do with video games? They just stream them. So what does GameStop sell? Old video games. There's still a market for it, but nothing like it used to be. But it became a hot stock by the Wall Street Bets forum, Reddit website, and Robinhood, because it had a huge high short interest by sophisticated investors betting that this company would go bankrupt. So what happened is all this retail money came flooding in. The guys that were short the company had to start covering, which only propelled the stock higher and higher and higher. It blew up a very big hedge fund that had $8 billion of money under management and eviscerated them completely. Well, the same thing has happened with AMC, even worse. Now AMC, everybody gets this one. It's a movie theater chain, right? Well, their business was already declining for years as people started going less and less to the movies. But then all of a sudden, COVID happens, movie viewership collapses, and what also happens? The movie producers, like Disney, can start streaming movies directly to your home television. Now, in the old days, movie theaters would have 60, 90, or a long period of time when new movies came out where they were the only one who got to show them. Now you have this option of streaming, and Disney didn't even give them any time. They would just take movies and stream them right to those, to people's homes. So the whole business model has been cracked, and AMC has lost billions of dollars. They've had to issue 5 times the amount of shares. It never has a chance of ever making any money, and yet the market cap of AMC is bigger than it's ever been in history. That tells you how broken things are, folks. Now, it's not just because of all the money that the Federal Reserve has sent in. There's another reason. Our capital markets have been moving to what is called passive index funds instead of managed money. And it's largely wrapped around ETFs. So think of it. You work for a company. You have a 401k. You put money in your 401k. That money goes off to a firm probably like BlackRock, T. Rowe, Vanguard. What do they do with that money? They're not actively managing, looking at one company versus next, one sector looking at another. They're dumping it into an ETF. Whatever basket of stocks in that ETF that gets all that money flows, those stocks are going to do well. The problem with that is there's nobody looking at and saying, does this company make sense in its value, or does this sector even make sense? It's just money on autopilot being jammed in, and it's some guy at BlackRock saying this company is in that ETF or it's not in that ETF. What's the hot ETF? Best example is the EVs, electric vehicles. So much money flooded in, helped one of the many reasons to create probably the most insane value other than AMC and GameStop, which is Tesla, valued at more than all the auto industry combined and double. In fact, they made an announcement they're going to sell 100,000 cars to Hertz, that sales will happen over like 5-6 years, and they've added $300 billion in market cap. I'm sure the CEO of GM and Ford says, we sell 100,000 cars all the time to the rental car agencies. I mean, it's crazy. But what happens, all this money flows into EVs, the more those stocks lift, the more money flows into it, the more the stocks lift, the more money flows into it. Nobody's looking going, does this make sense? So this is a big problem. I would encourage you all, even if you're having your money managed by some place like JP Morgan, a lot of their wealth management is just sticking you into these passive index funds. And it has totally distorted our capital markets and equity markets. Now, I'm going to touch crypto. Now, I know there's some of you that have made a killing on crypto. Good for you. Good for you. I sat there when it was, Bitcoin was at 28,000, and I thought, you know, this thing's probably going to run to 50, maybe 70, maybe 100, but I just couldn't do it. Why? Because there's nothing backing it. You know, at least, you know, you may not like what's happening to the US dollar, but at least we have a military, we own, you know, the federal government owns a lot of the land and buildings and assets and can tax all of us. There's a lot of things that back the dollar, even though they're not treating the dollar well. But there's nothing here. And let me give you some examples. I even was stunned when I looked at this. There's now 13,000 different cryptocurrencies. They're listing 2,600 new cryptocurrencies just in the first half of this year. Every day, they're creating new cryptocurrencies. There's this a show called Squid Games. I haven't watched it. I guess it's this real popular show on Netflix. And these guys created Squid Games crypto and got all the watchers of it to get whipped up, drove this cryptocurrency up 44,000%. Started off as a penny. The guys who created it cashed in. Guess what happened? Boom! Went back down, wiped everybody out. Look, a lot of the crypto market got started because of the black market, illegal crime, drug dealing, people trying to get money out of places like China. That's really what created it. Very interesting technology behind cryptos, blockchain technology. And now it's becoming institutionalized, and a lot of people worried about dollar assets and the value of the dollar. But this is insanity. Dogecoin, the one at the bottom, it was made as a joke. The founder of it, the guy who created it, said he did it as a joke. And yet today, its market cap is basically the equivalent of Walgreens. Think of that. Something is created by a joke. There's nothing behind it, and yet Walgreens that's on almost every corner store, sells you food and pharmaceuticals, which we all need both, and yet this thing with nothing behind it has the same market cap as Walgreens. Well, let's turn to the debt markets. Because of zero interest rates, corporations have feasted on debt. You've had an explosion. The blue line is investment grade. The red line is junk debt, high yield debt. The high yield market has issued more in the last 2 years. It issued $408 billion last year. And this year, it's on track to even do more through 3 quarters of the year. Well, it's done $408 billion through 3 quarters of the year, $423 billion last year. That's going to be a huge problem, folks. Let me take you to the next. What does this look at? This is looking at credit spreads and risk spreads. What does that mean? This is what they're issuing the debt at. And your credit risk is your default risk. Because why is it called high yield or junk debt? Because it has very high rates of default. When the economy turns over, a lot of these companies go bankrupt. And the people that own their debt get wiped out, just like the equity holders. Well, as you saw in 2008, look what happened to credit spreads and junk debt. Jumped all the way almost up to 25% because of all the defaults. Now, if you go buy junk debt, and again, a lot of people don't even realize how much exposure they have because they're just putting money in their 401ks, you're buying junk debt with a yield of 4.31%. When you factor in inflation, you have a zero yield. And not only that, you're getting a zero yield and taking massive risk where you may lose 25, 30, 40, 50% of your investment. The markets are broken.